Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Mike Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me today would typically be Michael Becker, but Michael Becker is on vacation. So we brought in Ricardo Hinojosa, also with Old Capital. Hey, Ricardo.
Hey, Paul. Great to be here.
Great. Thanks for being in the podcast with us. Today we have Brian and Meredith Sifford. Brian and Meredith Sifford. They are doing what you want to do. They own 100 plus apartment units in the Dallas-Fort Worth area. We're going to talk a little bit to Meredith. We're going to kind of focus the interview on Meredith with Brian helping us out, her husband, Brian. But we kind of want to figure out how they did it, how you could do it, by kind of listening to what their roadmap is all about. So welcome to the podcast, The Siffords.
Hello, Paul. Good to see you.
Hello, Paul. Thanks for having us.
No problem. So thanks for coming in today. So what I wanted to do is kind of talk a little bit about being successful in the multifamily business and a little bit about what you guys have done. So you guys have purchased a couple multifamily properties, and I want to kind of figure out where the success comes from. And so let's just start having a little bit of a conversation with you, Meredith. You know, this is kind of a team sport, but also can be done as an individual. So tell us a little bit about your background, and then I'll talk a little bit about Brian about his background. So Meredith, a little bit about your background.
I am a school psychologist, so I have a master's in school psychology. I've pretty much always been in education before school psychology. I was in elementary education. So the first time, we really started tackling real estate was just over 3 years ago. So I don't have a whole lot of background in finance or real estate, mostly in education. But about 3 years ago, my husband and I decided that real estate was the way to go for our retirement. And so we really got busy and started making connections and learning and just jumped into the business.
Okay. So Brian, what do you do? What's your background?
Well, I'm a senior chief in the Navy Reserve, Paul. And also I recently retired from corporate America to do the apartments full time. Before that, I have a degree in, from Sam Houston State and MBA from Incarnate Word and down in San Antonio, and just in middle-level management in corporate America.
So you're a young guy.
Yeah,
but you retired early from corporate America?
Yeah, we did. And we're blessed. We just started. We had one single-family house that we've owned, and then we had another one. And then about 3 years ago, we joined a real estate education and mentor group in DFW, Lifestyles Unlimited, and worked with the mentors there and some of the vendors, such as Old Capital. We sold our single families, and then we bought our first apartment in 2015, and then we just closed on our second one in March of this year, 2016.
Wow. So you guys have been busy for this last couple of years. Let's go back to kind of figuring out retirement. You guys both had full-time W-2 income positions. You kind of, it was transferred into the multifamily business. You guys were looking at other ideas to get into. What other things did you guys consider before you jumped into multifamily stuff?
Well, we started buying real estate on our own, as Brian said. So we had 2 single-family rental houses when we joined the mentoring group. And we came to the mentoring group thinking we needed to learn more about single family and just build our portfolio in that nature. And as we started to learn about the apartment business, we realized this was something we really could do together. And with the team that we started to surround ourselves with, we could be real successful. So we decided to sell our single family homes and go full force into buying apartments in the multifamily business.
How many single family homes did you guys buy?
We had 2 3 years ago.
We had 2 rentals, and then also we sold our primary residence to free up some money, and then we moved, and we were able to join into as a silent partner in an apartment purchase, and then after a few months of doing that, we decided we could buy our own and be the lead partner or the operating partner.
So my philosophy always says is that I like baby steps. So what you guys did is that you started off in the back of the airplane, so to speak, as one of the passengers, and you had made some investments with somebody else that was the captain of that airplane, the captain of that partnership, captain of that joint venture to buy an apartment building. So you kind of learned from that person, and then you immediately, probably over a period of 6 months, a year or so, after you kind of figured out how they were doing it, you said, geez, I can do that. I can fly this airplane. I can be the captain. So you moved up from the back of the airplane to the front of the airplane. Did you immediately become the captain, or did you guys sit like in the first officer position? Did you guys sign on the loan, or were you just immediately went into the captain's spot?
We immediately went into the captain's spot. It just made sense for where we were in our own journey to go ahead and jump in there. We also had some people that we had met that we were working with who were willing to kind of jump in with us as that co-pilot,
Sure.
and help us financially as far as guarantors. So in doing that, we did start with a smaller property, just 38 units, but we were really ready to run it and do it. And so we thought the best bet for us and our plan was to go ahead and purchase a smaller property and learn that way.
That sounds good. So let's jump into the 38 units. You guys bought that how long ago?
That would be a year ago in June. So June 2015, we purchased Oakland Oaks Apartments. It's 38 units in South Irving, built in the 80s. It's a great property. It didn't have a whole lot of deferred maintenance. It needed a little bit of foundation repair, very minor. But other than that, the roof was fairly new. All of the AC units were working well. There were no major repairs. What it needed was just some updates on the interiors. They really hadn't been updated since the 80s.
So talk to me about when you guys took this property under contract. How many frogs did you have to kiss before you actually got this transaction? How many properties did you have to look at, make LOIs, do the math on it, get involved in the best and final, not being chosen? How many times did you do that? Kind of define what that looked like for you.
I love that analogy, kissing frogs, because that's exactly how it is. We searched for 6 months before we came across this property. I don't even know the number, but it was, not 100, but it was a lot. We went through a lot. And we were also still learning the process. So we were really using our mentors and sitting down and going through financials and learning how to walk away from deals that did not make sense. So it was 6 months. It was a 6-month process before we found Oakland Oaks.
And so you find Oakland Oaks, and was that property marketed to the entire community, or there was an offering memorandum made, the property was listed for sale, there was probably, a person that was listing the property that maybe had 10 or 15 tours against the property. Does that sound right?
Initially it was, but this property just worked out in a timing aspect and in a connections aspect for us. Our broker was actually working with another buyer on this property, and he happened to be out of the country and just couldn't quite pull the trigger on it in the right time. So rather than, losing relationships and having that fall out of this broker's hands, she called us and said, I think this would be really great for you. Go drive through it, see what you think. And we immediately said, yes, this is a great property, got the financials. By then we were getting very good at analyzing properties. And so we were able to jump in and kind of be in place of the other buyer, rather than the deal falling out of that broker's hands. So
you found the property, kind of got the deal done. Walk us through a little bit about kind of what you liked about the deal. You'd mentioned it needed some interior upgrades. I've had the fortunate privilege of walking the property after you did the upgrade, so I know kind of the work that you did. But walk everyone through kind of how you came up with the game plan, where you saw the upside, and how you were able to execute it.
Yeah, we had our team in place already, ready to go. So when we did find a property, we were able to very quickly analyze, get bids, and make sure that it was going to work the way we thought it would work. So we had our general contractor come out and walk the units with us. We had foundation guys, roof guys, double checking, because, the selling broker will give you an idea of what the property needs, but you can't take that as a guarantee. You have to do your own homework and your own due diligence. So we had, all that checked out. We had the plumbing checked and all that checked out. And so really our plan going in was to just update the interiors. There was a little bit of parking lot repair that needed to be done. So new floors with the wood look vinyl, resurfacing countertops. Originally, we were using white refurbished appliances, but then we kind of did a test unit to see how much bang we'd get for our buck out of new black appliances. And that was a huge selling point. That's just not something that many of the properties offer in the area that it's in. Mm-hmm. And as soon as we started using the new black appliances, we had waiting lists. And we could even go up a little bit more on the rents for that amenity.
Do you remember what your rents were when you guys bought the property, and what are they today?
So the 1 bedrooms were $450 a door.
And the 2 bedrooms were $550, $575.
Okay.
And now for 1 bedrooms, we're getting $750, and for 2 bedrooms, a huge bump. At 2 bedrooms, we're getting $840, I believe.
We bumped it up to $860 last month.
Oh, $860. So it just keeps going up.
So why do you think the person who had sold it to you, were they under managing the property? Were they in the area? Did they not know the market? I mean, how can they be that far off?
Yeah, I think that was exactly what was going on, Paul. The person who ran it, she was part of a small group of investors. They had owned the property for 8 years. So it was cash flowing beautifully for them because they'd had it for so long, and they just never really paid attention to the market and where the rents were going. So it was one of the lowest rents in the market. And then, us going in and providing a superior product, we could raise rents even like we're leading the market in our rents right now there. So not only were we able to bring them up to market, we were able to push those market rents by the product that we provided with our interior upgrades.
So talk to us a little bit about the management. So at the time, both of you were working full time.
Yes.
So give us kind of an overview of how you ran the property. Did you do it yourself? Did you leverage third-party management? And how that worked out?
We did decide to use third-party management on this property simply because we both were working full-time jobs, and we just wanted to make sure that, especially being our first deal, we got in there and we did it right. We did have investors in this property, and so we really wanted to be good stewards of their money and our own money, and also having it being our first purchase, I think that was helpful in getting the financing and having third parties. So there were several reasons why we decided to go with a third party manager.
Going back to my airplane analogy, how many people besides you in the cockpit were there? There was you as the captain, and then how many KPs were there?
In this deal, we had, including us, 7 total investors.
How many people signed the loan?
There were 4 signers on the loan.
Okay.
Including us.
But that loan was not that large. Did you actually need to have all 4, or you just felt that you were trying to stack the deck to make sure it got done?
We were stacking the deck, and also there were a couple of our partners who, like you said, were interested in eventually buying their own deals, and so they wanted to get that experience as key principals. And one of them actually is in contract now, should be closing soon on a property, and that really helped. He's been very active and integral in learning from us to go off and do his own thing as well.
Just kind of pay it forward type of stuff?
Absolutely.
Okay. So you had 7 investors in the deal, and how much money did you have to raise between that group?
We raised $550,000 total.
And did you guys do a PPM at that period of time?
On this one, it was a small group and mostly family and close friends. So we created an LLC at our lawyer's recommendation. So we did not do a PPM for that property.
Because it was a small transaction. You guys pretty much all knew each other,
yes.
Family and friend members in the transaction. I get that. And so you guys did a loan that was the acquisition plus the rehab that was included into the loan dollars?
Yes, we did a recourse loan on this property, and we had $185,000 in rehab that was included in the loan, and 6 months of interest only on that loan.
So heading into your second deal, I do want to just kind of move forward to that one. So you went from 38, learned a lot, kind of learned the ropes, and moved into your latest acquisition, which is, I believe, in the same submarket, at South Irving submarket. Give us kind of an overview of that property, how you found it, and kind of how that came to be.
Sure. So that property is Willow Bend Apartments. It's 60 units in South Irving, like you said. It's a little bit different than Oakland Oaks. It's a 60s property. It was built in 64, and it's a much stronger value play, as some people put it. It needed a lot more work than Oakland Oaks. So there was quite a bit of deferred maintenance. There's some plumbing problems that we're fixing, roof issues, landscaping, drainage. But it also was very much stuck in the 60s as far as the interior. So we had that interior upgrade component that we could do as well to help push rents. So it was a bigger undertaking as far as rehab and that kind of thing.
From the period of time you bought and closed on the first one to the time you found and closed on the second one, what was the time frame in that one again?
Let's see. So we closed on Oakland Oaks in June of 2015, and then we found and got into contract at Willow Bend. It was around the holidays, so it was late November of 2015, and then we ended up closing late March of 2016.
Okay. And so you guys, when you were under contract into the transaction, you had a physical needs engineer or somebody that took a look at the property and kind of determined on your behalf what kind of repairs, rehab you guys were going to need on that property.
Yeah.
First of all, was that a good idea to hire somebody to do that?
Absolutely.
And what did they uncover on that property?
On that property, there were some major drainage issues, which part of that was, I guess, luck on our behalf. It happened to be a very rainy season while we were in contract on that property. So it became very clear that there needed to be some French drains and that kind of thing put in. No foundation issues with that, luckily, but there was one building that needed a roof repair and then some pretty major sewage repair that needed to be done.
Yeah, in addition to the sewer repairs, 3 or 4 buildings needed their main lines, a lot of work done on them. And then basically the laundry room was
not functioning.
And just
So the seller had really never improved or made a laundry room work? Or was maybe
Yeah,
one
they were
machine?
in contract. They had a contract with CoinMac. So, I mean, I guess they just never pushed for the repairs to happen because the machines were in bad shape. I mean, and just dirty. And you could tell they weren't being used just by looking at them.
Yeah, the seller was out of state.
He was. And he hadn't set foot on the property since like 2008. So he's never there. He had several different management companies come through and manage the property for him.
And that took the tenant composition, that lowered the standards there too. So the first few months we spent replacing some tenants that just needed to go.
What do you think about this laundry, this CoinMac deal? I mean, everyone has opinions of that. I mean, laundry lease contracts will be the last thing standing after the atomic bomb.
Well, so that was one thing that actually worked in our favor with this property. They were, the same month we closed was the end of their contract with CoinMac, and that management company did actually have the forward thinking to go through all of the hoops you have to go through to cancel that contract. So once we closed, we were no longer in a laundry contract. So we were able to decide what we wanted to do. So our options were very open.
What'd you guys decide on doing?
We decided to purchase washers and dryers and run that ourselves. So we're going to have a third-party maintenance contract so that we don't have to maintain the machines ourselves. So we purchased brand new machines.
What does that cost?
So we bought 6 coin-operated washers and then 3 double-stack dryers, so a total of 6 dryers. And the total purchase price, I looked at a few bids from a few different companies in DFW, and I think I went with some Maytags, and that was about $15,000 right at that, installed.
What's your cost getting your money back? How long is it going to take you to have those in place?
Well, we estimate on the high end we'll get probably $800 to $900 a month from them. But on the low end, $700. So it's a good
Just
return on
over
our
a year.
money.
So it probably takes you about a year or so to get your money
Just
back?
over a year, we're thinking to pay for those.
Are those in place right now?
They are. They were actually installed last Thursday for the road trip on Friday.
Good.
Yeah, so the nice part about that, they will pay us back in a timely manner, but also it's increasing our net operating income immediately. And so that's going to increase the value of our property very quickly.
Yeah, those laundry contracts, depending on what part of the country that you are in, but in Texas, we don't have very many choices about laundry contracts.
Yes.
They're usually 10 years, and they're pretty specific in the language that says that you only, like a 30-day window.
Yeah, and you have to write a letter within this time period to say you want it to end. It's
And if you don't write the lender, the contract to cancel it, it gets renewed for another 10 years.
Yes.
And so that becomes very difficult. And that flows through the property. So even if you were to sell the property, the next buyer would pick up the contract again. So when you're buying properties, look for what's left and what's remaining on the contract itself.
And that's all part of that due diligence piece as well. You're going through the leases, but you're also going through all third-party contracts to know what you're obligated to once you purchase that property.
So you guys did a lease audit on the property.
Yes.
You've closed on the transaction. Now you guys are operating the property. Going back to the leases, anything that you found out afterwards that you didn't see on the front side when you were doing your lease audits?
I don't think they had a very strong screening process for their tenants. There were some criminals on the property that had to go pretty quickly. So that was the biggest thing. Also, there was 100% physical occupancy when we purchased the property, but the economic occupancy was not what they were saying it was.
Yeah, that's always a tough thing because when you look at a rent roll and it says 100% occupied, I mean, it takes nothing to fill these units up. I mean, anybody can put bodies into these rooms. The tough thing is to collect the rent from all these people in the property. So when you guys really started to do the numbers, I mean, what do you think your economic occupancy was on the deal? From 100% down to
In the 70s, probably.
who actually was actually
pretty low.
paying the rent on the properties?
We processed a lot of evictions the first 3 months of ownership.
I would say probably in the 70s for economic occupancy. Maybe 75% of tenants were actually paying.
Now, is this an all bills paid property or individually metered?
It is actually individually metered, but the previous owner, when he bought the property back in '08, did a big rehab on it. He bought it from foreclosure or something like that. It needed a rehab. And he had combined with the water heaters. The downstairs and upstairs unit just shared a water heater when you put brand new water heaters on the property back then. So doing that, even though it was individually metered, kind of made it an all bills paid property or a master metered property.
And how are you guys running the property now?
We are now running it as all bills paid. It just, for us, it made better sense. And in that submarket and with the recommendation from our property supervisor, who really knows that submarket well too, it was the way to go with this property.
I would probably imagine because of the plumbing, electrical, everything connected together, and knowing the demographic of that submarket, where you have some great tenants in the property, but they may not have enough credit to qualify to get electric in their name.
Yeah.
And there can be a way of passing your savings with an electrical utility contract to the tenants so you actually could get electric cheaper than what they could get electric for.
Absolutely. And that's something also, a contract that was turning over as we bought the property was their electric contract. So we were able to negotiate a really good price on an electricity contract.
Right.
So let's take a quick step back. So you're under contract. Let's talk a little bit about the financing on the deal, because that I know was a little bit of a challenge because of some of the things that you mentioned, right? It was a rougher tenant base, older property, much older than the first one you purchased, a larger asset that, it was definitely rough around the edges. So talk us through that process and kind of where we ended up.
And this is another great example of having your team in place, because that first property, it was an 80s property. It wasn't as big of a risk for a bank to put a loan on. And so it was a pretty smooth process as far as the financing. This property, like you said, it's an older property. It's a 60s property. It needed a lot of work, some deferred maintenance, and it was a much bigger risk for a bank to finance. And so we had a team in place and set up, and it didn't work for this property. It wasn't the right team for this property. And we found that out pretty quickly. And, lucky for us, we're connected with this mentoring group, and we got to know Ricardo and Paul through Oak Capital, and they really jumped in and helped us find the right lender for this property and get our team back in order to be able to close on this deal.
And one thing for the initial financing on this property, we approached the bank that financed our previous one because we had a relationship with them. And they tied it up for 30 to 40 days and then came back finally and said, hey, we can't do it. So then we had to go to the bench. Thank you, Paul and Ricardo, for coming and helping us.
Big time.
But, we had to go back to the seller, establish some credibility with the seller. I think, Paul, you closed this property before, haven't you?
I've done the financing of this property, I think, 3 or 4 times in the last 20-some years. So.
And that reassured the seller. So they were amicable to extending the contract, or basically setting up a new contract, giving us another 45 days financing contingency period, and really helped get this one done.
One of the things that I do remember about that transaction is that you put a good team together for your signers on the loan. So this was going to be another recourse deal. And Meredith is correct and Brian's correct, is that this was a little bit more of a hairier transaction, that there was a little more things that we had to mitigate some of the risk. And so one of the things I think that you guys had done to get the bank to be comfortable with it is, instead of putting more money down in the transaction, we actually hold, or the bank holds, a CD. And what is that, about $100,000, $150,000?
It was 165.
165,000, but it has a threshold. So when Brian and Meredith hit a threshold of X, whatever X is, and they can support that for, say, 3 to 6 months, they'll release the CD back to them. So instead of putting the money up front into the property, with them only be able to get that money back out if they refinance it, that we negotiated with the bank that hold 160, keep it into an interest-bearing savings account, and then when we do hit those thresholds, because we know, we believe in our plan, then we'll release the CD back to the Siffords, which I think was a good way of putting it together. It keeps the money into the transaction, but doesn't lock the money up in the deal.
Indefinitely, yeah.
And it allows for us to increase our return on the property. If we just had to raise that money and get a lower percentage of financing instead of a full 75% financing loan to value, it would have lowered our return.
So in this transaction, you guys used a third-party property management company on that one?
Yeah, we used the same company that we're using with the first property. The 2 properties are just minutes away from each other, and so we were able to work it out with our management company to share staff between those 2 properties.
So are you using the same management company that has the same leasing person or the same maintenance person?
Yes.
All the same manager, same property supervisor, and same construction team running the rehab.
Wow. So the construction team is being run by the management company.
There's 2 legs of the management company. They have a property management side and they have a general contracting side.
Okay.
So we're using them as property managers and as general contractors.
And they kind of dovetail together because they speak with each other, same company.
It's the same company.
Which I think is a great deal.
Yeah, it works out nicely.
Because everybody's on the same page. They all talk about what's going on. They have somebody that runs both sides of the table and communicates directly to you guys about what's going on. So where are you guys at on the rehab of this property right today?
So we bought the property March 30th, and right now it is August 22nd. We have completed rehab on 23 units. We anticipated doing 40 units in the first year, and so here we are just 4.5 months into it, and we're more than halfway to our goal.
So going back to you guys take over the property, do you remember what your rents are? What they were then, and with this rehab, what are they now? Just a ballpark, if you remember.
And the property consists of 49 2-bedroom, 1-bath, and then 11 1-bedroom, 1-bath. So the 1-bedroom rents were $675, $680 is what they were averaging.
And that includes the electric too.
Yes, I'm adding that on. Yes.
Okay.
And so right now we're renting the 1-bedroom after rehab for $875.
Wow.
And then the 2-bedrooms, when we took the property over, they were right at $820, $830, depending upon which unit it was. And we're getting $1,000 a month, and we just leased another one at $1,050. So we're pushing the market there.
Are you getting any pushback on that number, or is that being accepted in the market?
The $1,000 is easy. The $1,050 we received some pushback, but we're getting what we can.
Put any backsplashes in that thing?
Oh yeah.
Yeah. So this property, the before and after is such a big difference because it's a 60s property. And, in the bathrooms, it still had the old tile up the walls. And so we took all of that out, re-sheetrocked, glass backsplash in the kitchen and in the bathrooms, new framed mirrors, light fixtures, 2-tone paint, wood-look vinyl floorings, black appliances. So we've really made it look very nice and updated. And the word gets out pretty quick in a community when there's a nice product and somebody's rehabbing these properties. And we have a waiting list for people wanting to come and move into our properties.
So Brian has just pushed over a picture of one of the unit kitchens, and There's two pictures here, one on the left, which is like the before, and one on the right, which is like the after. Completely different look to the property. The one on the left, the countertops, looks like the last time that they were sprayed was about 10 years ago. The pulls on, you guys painted the cabinets.
Yes, we went with white cabinets this time.
And you
for a
went
more
with
modern look.
black appliances. And the white cabinets look fantastic. Different light fixtures in their property, different dishwasher on the property.
Yep.
All new appliances, yeah.
So what we did was standard replaced all the flooring, consistent 6mm wood look vinyl plank. That's pretty resilient and looks great throughout the property. And brand new black appliances, brand new brushed nickel low consumption electrical fixtures, and then brand new brushed nickel low flow water fixtures throughout the entire unit. All brushed nickel hardware, cabinet pulls, towel bars, two-tone paint.
What do you think
throughout.
that costs per unit on the per unit basis?
I'm pretty sure it cost about $7,500 per unit.
But now you've raised the rents almost $200+, and so now it's coming back to you in spades. So
Yeah, we're definitely getting the bang for our buck on that one. The other thing that we're about to start is water conservation. And being an all bills paid property, that's really going to impact our NOI, is to be able to get all new toilets and fix every leak in every unit.
Some people who have never been in the multifamily maybe don't know what kind of an impact that has. But so talking a little bit about this water conservation program, what are they going to do to your property, and what do you think that's going to do to the NOI, the net operating income?
So we contracted with the company. She's going to come in, or the company's going to come in rather, and replaced every toilet on the property. Right now they have 1.5 to 3 gallon flushes, it seems, and they're going to be down to a 0.6 or 1.2, right about a 1 gallon flush. And then they're going to replace every valve stem and any bath fixtures we haven't replaced. They'll replace every valve stem. They'll replace every tub diverter with one that works. Low flow shower heads, and just really, they're going to basically cut our water consumption on the property in about half.
Yeah. So on these all bills paid property, you're the one responsible for all the expenses on the property. So you're trying to reduce the amount of expenses as low as possible, with still keeping the property running and being updated and things like that.
Right.
But this water conservation program is unbelievable on what it can do, and so that is a line item that it's going to kind of go away or be reduced, and so it's going to give you increased NOI.
Yes.
So what do you think, what does that translate to, just in your mind, of how much money you guys are actually going to have to save, which means how much money that's going to go back into your pocket?
Sure. And right now the water bill is about $28,000 a year. Mm-hmm. After the water conservation we hope to save, that's the water and sewer together, about $10,000.
So it's going to save you about $10,000. So it's going to be about $18,000 or so. That's great.
Right.
So the savings is going to be dramatic on how much money to the bottom line, and also to the value of the property that's going to do for it too.
Easily adds $100,000 to $120,000 in the value to the property.
So you guys went big on the interior upgrades, talked about the water conservation. I know you also have some plans for the exterior of the asset, some of the amenities. You talked about the laundry room. Any other amenities that are kind of in your outlook, kind of what you're doing to the exterior?
Absolutely. So outside of the laundry room, there's a big open grassy area. It was probably once a pool that somebody filled in along the road. And so it's kind of just an open area that nobody really uses, and there's a lot of space. So we would like to put some kind of covered, maybe picnic tables, a Playscape, just something because it's a mostly 2-bedroom property. So there are quite a few kids on the property. So something that families can come down and enjoy and actually use that space. When we first purchased the property, a lot of times people like to go in and do the exterior things first. So people driving by can see, there's something going on there, and it sparks interest. But because we had to drop our occupancy so low, because our economic occupancy was so low, we really wanted to focus on getting the interiors done, getting that leased up. And now that we're there and we're over 90%, occupancy, we can start kind of doing those things and planning those things out.
So long term, what's the strategy with the deal? Do you think you see this as a longer term hold, or is this kind of a shorter fix and flip type of situation? What's the strategy with Willow Bend?
The strategy going in is to have everything completed as far as rehab within 2 years. We're way above target on that, so that'll be sooner. And then either sell or refinance. It just kind of depends on where the market is and what our investors want to do. there.
Yeah, you'll definitely have some flexibility.
Yes.
The nice thing with the debt is that there is no prepayment penalty at all. So they've got a ton of flexibility going in. They've got a 5-year term with, again, a lot of flexibility on the back end to kind of tailor it to your needs.
Yes.
So that works out well.
Education, besides being in this mentoring program, did you guys take a CAMS class or any other classes? Tell us a little bit about if that was a benefit for you, and where do you find those kind of classes that you can learn?
Absolutely. Through the local and national apartment association, there's all kinds of certifications and offerings. And I took the CAM, which is Certified Apartment Manager. I felt that was extremely beneficial because the mentoring program and the education program that we're in is amazing. And it really helps you set your team, and people there really know. But the CAM course really goes into detail about fair housing laws, evictions, tenant laws, just the nuts and bolts of running a property. And although we had planned to have third-party management, we wanted to be able to make sure that we were able to keep those people accountable and make sure they were doing, things right and what we expected.
Because sometimes you don't know what you don't know.
Right.
And so
Absolutely.
it's good to get some of those classes out of the way. What else were you going to add, Brian?
And Meredith was able to take the CAM online, so it was pretty flexible even while she was working full time. I had to take vacation days, and I took the CAM-T, which is a maintenance technician supervisor certification, just because I wanted to get a little hands-on experience. I built houses in a previous life, so I know construction, but I wanted to know more about the apartment side. In a couple of days, I'm starting the CAPS class, which is a Certified Apartment Portfolio Supervisor with North Tarrant Apartment Association.
Do you think those classes are valuable?
Absolutely, yes.
Yeah. So you would recommend that?
Absolutely.
Talking about look at yourself now and look at yourself, say, 3 years ago when you guys started to think about getting into the multifamily business. What kind of advice would you give to somebody that was thinking about getting into the multifamily business? Would you recommend them doing it? What would you tell them to be the first steps to do?
As far as, my opinion is most people can do this. It's not something you do on your own. So I would not recommend going in on your own. Don't try to figure it out. It's a very intricate.
You could do this as a single woman.
Oh, absolutely.
So there's you don't have to have a husband or a spouse as a team member. You could do this as an individual.
Yeah, Brian and I just happen to work really nicely together, and our strengths kind of suit each other. And so, we're lucky as a married couple that way. But there are some married couples that we know that the husband has the higher income and so keeps the job, and the wife is running the business and doing amazingly at it. And like I said, it's not something that you go alone. There's a whole team of people in place, and you just have to get involved to start to meet your team and learn about the different industries that are involved. And if you build the right team, it's absolutely anybody could do it.
And hesitation or fear of doing anything unknown is always the biggest roadblock. Once again, the Old Capital podcast, we listen to the Lifestyles Unlimited podcasts and just to learn stuff and get an education, because the more information you get, it makes you feel more comfortable, stretching your goals a little.
What's on the horizon for you guys? What do you guys see in the next year?
So in the next year, we're just about to start our search for another property. So we want to go much bigger, 150 units or more, something that can sustain its own staff, and operate as one business. And then Oakland Oaks, that property, we purchased it, the 38 unit, to eventually sell it and move on. So we'll be looking to position that to sell here pretty soon and just keep growing and conquering.
So looking back, so you gave us kind of a feel for some advice. Is there anything that you would do differently based on what you've gone through the past couple of years?
We would have started years ago. Instead of just dabbling and buying a house here and there and reading books, we would have gotten involved in an education program years ago.
Yeah, and like Meredith said, I read all the Kiyosaki books and all that, and then always thought we could do it ourselves, but we just got 2 single-family houses, and we weren't making anywhere near the cash flows that we see our friends making now, and just would have gotten involved in education sooner and made the leap sooner.
Some great information from Brian and Meredith. We do appreciate them coming to the podcast. Ricardo, thanks for hanging out with us. We appreciate that. Remember that if you like the information you hear and you have an opportunity to go to the iTunes, please give us a 5 rating. The piece, if you do need to get more information about multifamily financing, go to the white paper, the Old Capital Multifamily white paper. It's about a 15-page report about structuring financing on multifamily properties. The last thing is, Ricardo, fight of the century for your business between Fannie Mae and Freddie Mac coming up September 21st at the Grapevine Convention Center.
It's going to be a huge event. Everyone show up. It's going to be fun.
It's going to be a great event. Fannie Mae and Freddie Mac are fighting for your business. Listen to both of them, make a pitch to why they should be your lender in upcoming future transactions. Again, we appreciate the business. Anything more to add to this, guys, at all?
No, just thank you for having us, and we're excited about what the future holds.
Yeah. Thank you very much, Paul and Ricardo. Appreciate y'all having us and everything y'all helped us out with, and looking forward to business in the future.
No problem. Last thing I wanted to say is if people want to get a hold of you, what's the best way to getting a hold of you?
Sure. Our contact information, my last name is Sifford. It's Sifford at 1791.com. Just 1791.com.
All right. Brian, Meredith, thanks for hanging with us. We appreciate your business.
Thank you, Paul.
Thank you for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitallending.com to sign up for our weekly email updates. We'll see you here next week with another great interview.